Liz Everett Krisberg, head of the Bank of America Institute, joins us now. Liz, with inflation that high, are people going to spend throughout the holiday season, or are they just going to, search for bargains on these big days and then go away?
Well, it's a great question, John. Thanks for having me on. I think when we look at the data across the 68 million Bank of America consumers, what we're able to find and what we're seeing is that consumer spending is moderating. And in order to really understand what's driving the consumer spending, I think it's really important to take a step back and understand what's happening in the labor market, just as Janet Yellen had alluded to. And what we're seeing in the labor market is actually also moderation. What we're seeing in terms of income growth and what we look at Bank of America Institute isn't just salaries, it's all income that's coming in after tax into the consumer accounts. And what we're seeing there is that while wage growth and income growth is still positive, it's really moderated quite significantly from a year ago. The other thing we're seeing in terms of the labor market and income levels coming in is that slowdown, while gradual, is also broadening out across the labor market. It used to be predominantly with higher income households, but now what we're seeing is that slowdown is actually impacting middle and lower income households as well. And just to give an example of that, higher income household income growth was up 0.4% this month, while lower income households were up, their income was up about 2.6%, but both of those are significantly lower than where they were last year. Higher income households up 4.5% a year ago, again down to 0.4%, where lower income went from 3.8 to 2.6.
So Liz, tell me what you're seeing in the velocity of this slowdown, because I've been wondering whether the high level of consumer debt that's on the books combined with these higher costs in areas like housing are going to cause consumers to hit the brakes on spending faster. But I don't know that we've seen that yet.
We haven't quite seen that yet. And again, what I'd say, both spending and income are moderating, but the spending growth is moderating more. And when I say spending growth, I'm talking more about the card spending. It's moderating more than the income. And part of that's because when you think about consumer spending, as you alluded to, some of the larger ticket items than those ticket items that are more impacted by higher rates. Think about your mortgage, think about rent, think about student loans. Those we're not seeing. Those are going up faster, and that's where the consumer, I think, is taking some of their money and spending it there as opposed to putting it on their cards, their debit or their credit cards. That being said, one of the things we would expect to see if the consumer was feeling a lot of pressure was a shift from spending on debit cards to spending on credit cards. And we haven't really seen that yet. So we're looking for it, but again, I think the consumer still is resilient even if they're moderating.
If there's a Jenga piece here, is it employment? Is it the fact that employment has been so strong, has that allowed consumers to keep spending? And if that takes any kind of a dip, is that a concern?
I think it certainly would be a concern. I think one of the other things that we look at, and you've been spending a lot of time so far talking about job changes within the tech industry, right? What we're able to look at in our data is job changes, again, across the whole spectrum. And what we've seen recently is a real downturn in the number of people who are changing, going from job to job. We're back at levels that are closer to where we were pre-pandemic and certainly a lot lower than where we were, even a year ago. And the other thing that I think is really interesting about these job changes is the pay bump that people are getting when they change jobs has softened significantly. It's about half of the rate of increase for changing jobs today that it was a year ago. So a year ago, you might have been getting a 20% pay jump if you switched jobs. Now it's closer to 10%. So I think that's reflective of kind of slower hiring, but also some reluctance on the part of the consumer and some concern there about in an uncertain market.